And the nice thing about doing tax planning during tax season, tax prep season, right, is you have all those numbers in front of you of what was last year. Really, the big question then is what changes moving forward, right? And you can move those numbers up and down accordingly, but that gives you a good baseline scenario of what's a normal year look like. Was last year normal, or was last year up, high, or low?
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. I have a special guest this time. It is Corey Hulstein. He is a certified public accountant, or a CPA, acronyms we like to use. He's also the director of tax here at Barber Financial Group. Corey and I are going to be discussing something that may be foreign to a lot of CPAs today, and that is doing tax planning during tax preparation season. Stick around and enjoy my conversation with Corey Hulstein, CPA. Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time, and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation. All right, Corey Hulstein, you are the Director of Tax at Barber Financial Group, CPA. This is your first time on the Guided Retirement Show, and it is great to have you here.
Yeah, thanks a lot. Looking forward to it.
So we're going to talk about something that would be foreign to most CPAs, and if it's foreign to most CPAs, it's going to be foreign to just about everybody listening to us. And the concept here is that you can control your taxes, especially during retirement, unlike any other time in your life. But you control your taxes by doing forward-looking tax planning, and there's no better time to start the tax planning than during tax season.
Yeah, no, that's exactly right. One of the things we want to look at doing is, let's take a look at what the calendar looks like early in the year, right? Let's figure out what the budget looks like, what the finances look like, what's the market doing. Let's evaluate all our different options early in the year. Let's put a plan in place, and later in the year, we'll check in on how that plan's going.
The reason I said it's foreign is because during tax prep season, most CPAs are so busy preparing tax returns that they have very little time to commit to sitting down with their clients and mapping out a strategy for the coming year, and one that might even affect the following year or 2 years down the road.
Exactly right. And one of the things your CPA might do is he might, sit down and figure out what your quarterly estimate should be, but that's not really planning either. That's just simply doing kind of the bare minimum to make sure we don't screw something up for the next year. So really looking forward, doing proactive work there is where we can provide some value.
One of the things I want to talk about is that forward-looking proactive planning that should be being done during tax season, and I say that because it's early in the year, is something called a QCD, or a qualified charitable distribution. Most people that are charitably inclined know that once you've reached age 70 and a half, that you can actually make charitable contributions from your IRA directly to the charity. And so that distribution never shows up on your tax return. So it won't cause more Social Security to become taxable. It won't cause dividends that may have otherwise been tax-free to become taxable. There's a snowball of events that happen when money comes out of that IRA. But by doing those QCDs early in the year, then you really know what that required minimum distribution is going to be like and how that's going to fit into the overall tax plan for that year.
Right. And then the QCD applies towards the required minimum distribution. So if you wait until November, December, right, that RMD is already met. That QCD is far less valuable in November and December when that RMD has already been taken. Right.
Yeah. The only caveat that I guess would be is if somebody needs the RMDs, the required minimum distributions, and they're using that money to live on, then, the QCD still is effective. But you're right. If the objective of the QCD is to reduce the required minimum distribution so that you don't have as much taxable income, then it is far more valuable to get that done early in the year.
Absolutely right.
So there's always some surprises that people get. So there are years, and we had one in 2021, where a lot of people had some pretty substantial capital gains that they had to pay taxes on in 2021. And I know that the tax software that most CPAs use is going to assume that the same thing's going to happen the following year, and oh, you owed money for this tax year, so you should start making some quarterly estimates. But that's just kind of saying, hey, we think everything's going to be the same. When you have large capital gains, it's typically not the same every year.
Yeah, and part of that is just to make sure people don't get penalties on their quarterly estimates, right? And if we don't look forward and do actual projections of what those capital gains are, the easy answer is let's pay enough to cover our last year's tax balance, which probably isn't going to be a good fit for the upcoming year.
Right. Well, don't you think, though, it makes sense? I mean, the reason why I love having you and your tax team here right in the office working with our certified financial planners is because, when you're making a quarterly estimate, you're making a quarterly estimate based on what you think is going to happen. But when you have the information, you're talking to the client, you're talking to their certified financial planners. Okay, what's our capital gain situation look like here for the first quarter? What does our capital gain look like for the second quarter? And if there are capital gains and it looks like that might trigger the necessity to make a quarterly estimate, you can then do it. But then you're really doing proactive planning there, and you're not just needlessly sending money off to the government as a free loan for 12 months.
Yeah, that's how it should be done, right? And not everybody has that capacity. If you're working with an individual CPA, they're not going to know what's going on the capital gain side. They can't check in with an advisor every quarter. That's where we get a lot of synergy is we're right down the hall from each other.
Yeah, absolutely. I think that we were kind of joking around before we started the podcast today, and I can remember back in the day where before I really knew what tax planning was supposed to be. And this was very, very early in my career. And I'd sit down with the CPA and we'd get together and we're doing tax preparation, right? And I'm like, okay, what could I have done different? What can I do now to reduce my tax bill for the prior year? And the reality is there's almost nothing, right? Unless you're going to make an IRA contribution that's deductible or something like that, there's really almost nothing by the time you get to the tax preparation time that you can go unwind something that happened in the prior year. And so the concept of tax planning during tax prep season is let's reflect on what happened in 2022. Let's think about what we're going to do in 2023. And one of the things that becomes really important, especially for people that are in retirement, is what is your spending going to look like this year? And where are you going to get that money from? And what's the most tax efficient way to get that money for that calendar year?
Yeah, and you're exactly right. And the nice thing about doing tax planning during tax season, tax prep season, right, is you have all those numbers in front of you of what was last year. Really, the big question then is what changes moving forward, right? And you can move those numbers up and down accordingly, but that gives you a good baseline scenario of what's a normal year look like. Was last year normal or was last year up, high, or low, right? And we make adjustments from there.
Yeah, and one of the other things that's happening, in the last, let's call it 9 months, we have seen a significant increase in interest rates. And so there is a very good possibility that if you're looking at interest income and maybe it was $4,000 or $5,000 in 2021, 2022's interest income could be 3 to 4 times that. 2023's interest income could even be more than that. And so you need to be looking at those types of things and asking the question, well, if that interest income is causing unintended consequences, maybe we need to look at a tax-free alternative like municipal bonds, which actually look attractive for the first time in years.
Yeah, absolutely. And that's an easy one to miss, right? Because you look at interest and you say that number's not going to change, but you bring up a good point. Rates have gone up 3-4 times. That number's going to climb quite a bit, right? So that brings up a good point of municipal bonds. How do we get money into tax-free investments? That would be another strategy that we could utilize for things like tax bracket planning.
Okay, so we talk about tax bracket planning, and I want you to give a little bit of an explanation. So let's say that you probably don't have the tax brackets memorized off the top of your head. I always got to go back to the little sheets, but let's say that you had a couple that had total income of, say, $110,000. What would you do for tax bracket planning there?
So I think the thing you need to do is always frame it within their situation, right? Is 12 to 22% a good rate for them? For some people, that's a great rate, and for some people, that's a terrible rate, right? But when you're talking about tax bracket planning, they're going to be close at 110,000 to the top of that 12% bracket. If the reality for them is they're going to be paying at 22, 25, 28% rates in the future, let's make sure we utilize the full 12% bracket. Even if we miss it a little bit high and pay a little bit at 22%, that's still better than leaving meat on the bone there in that 12% bracket.
Yeah, so that's a great point. But in order to really understand whether that makes sense or not, you might have to look forward several years. So let's say that this person was in their early 60s, they retired early. They've got more money than what they're probably going to spend, and so we need to look forward and ask the question: what are the required minimum distributions from their retirement plans going to look like? And when they are forced to take that money out of their IRAs and 401ks, what tax bracket is that going to throw them into in the future? And can we get some money out of that IRA this year or next year at a lower rate than what we know we're going to pay in the future?
Right. And that's where your planning software comes into place, because I can't do that on my own, right? And then you think about, too, what are tax rates going to be in the future, right? We know what those 2026 tax law changes are likely going to be. We don't know what Congress will do, but are there more unintended things that happen from a tax perspective, too, right? We don't know all those answers, but we do know we're in a pretty low tax environment today.
One of the things that causes, I think, the biggest surprise on people's tax returns when they retire, Corey, is how much of their Social Security can actually become taxable. And when Social Security was originally enacted, it was intended to be a tax-free source of income. And I always tell people, well, it still is a tax-free source of income unless you disqualify yourself. And most people are like, well, how in the world would you disqualify yourself? Well, you have too much of what's called provisional income, which is a special formula that's used to calculate how much, if any, of your Social Security is taxable. And one of the things that you do in the tax planning aspect is you look at what are the different sources of income that a person has available to them. All right, we've got Social Security. We've got some money in a taxable account. We've got some money in a Roth IRA. We've got some money in a tax-deferred account where when we pull it out, we pay taxes on it. If you understand how much income they need net of taxes to do the things that they want to do, and you know all the sources, then you can all of a sudden say, these are the different accounts from a tax perspective that you should be pulling money from that will have you pay less tax on Social Security.
Yeah, exactly right. The different streams of income in are all taxed differently. So we're just kind of turning on different spigots to say, let's get ourselves to the right landing spot so we're not having unmitigated problems with Social Security. But it also pertains to, do we turn Social Security on any given year as well, right? That's got to be part of the thinking, part of the thought process of what does this upcoming year look like? Where are we going to grab money from? Is Social Security the spigot we turn on this year?
Right. And I think that one of the really nice things that you're able to do in your tax team is when somebody's getting ready to claim Social Security, or we think it's, 2023 is going to be the year to turn on Social Security. All right, let's make sure that from a tax perspective, that's really the smart decision. Are there other things that turning on Social Security in 2023 might adversely affect that might outweigh the benefit of getting a Social Security check in 2023?
Right, because my goal is to minimize taxation, not only today, but over your lifetime, right? So are there certain steps that we want to take between now and age 70, which is the latest we can turn on Social Security? Are there things we want to do during that time frame that we kind of want to hold off on Social Security to maximize over our lifetimes, not just necessarily today?
And, there is a right answer for everybody, but it's not something that you open a book and read it and say, this is the step by step. This is not like an engineering or a math problem or putting together a puzzle. This is something that is unique to each individual's situation, which is why having these conversations with your CPA and your certified financial planner at the same time, they can really put tens of thousands of dollars in your pocket by sending less money off to Uncle Sam.
Yeah, and I mean, there's always going to be variables, right? Growth and duration of life, all those different things, but we at least can give you the tools to know what decision you are making, right? Give you that information to help you make the best decision possible.
Well, and of course, those decisions on a year-by-year basis can change.
Absolutely. It depends on what the market's doing. It depends on, inflation and all those different aspects too.
So, Corey, let's talk about some more charitable things like donor-advised funds. now we got a couple more years to do this. We've got the 2023, the 2024, and the 2025 tax year. So we've actually got 3 more years to take advantage of the higher standard deductions that the Tax Cuts and Jobs Act brought in a few years back. And when that Tax Cuts and Jobs Act came in, it really, it was a benefit to some people, but to some people, it was not a benefit at all, where, they were able to write off their state and local income taxes. They were able to write off their charitable deductions. But if those charitable deductions aren't big enough now, then they really don't even get the tax deduction for it because they're not itemizing anymore.
Right. Yeah. I mean, if you walk through what that Schedule A or itemized deductions look like, for people who don't have a mortgage, their state income taxes and property taxes are capped at 10. All of a sudden, you need to contribute $15,000 to $20,000 to charity just to get $1 of benefit. It almost disincentivizes giving to charity to some degree. Now, things like donor advised funds, there's ways around it, but it takes a lot of planning in order to get there.
Right. You use a technique called bunching, right? So what you might do is you might say, okay, an individual normally gives, I'm going to make up a number. They normally give $5,000 a year to charity. Well, if you only get to deduct your state and local income taxes up to $10,000 and you're giving $5,000 to charity, that's only $15,000 on your itemized tax reform, where your standard deduction is over $25,000. So you get zero benefit. So by giving to a donor advised fund, you could give, say, 10 years in advance worth of those $5,000 gifts. And so you put $50,000 into a donor advised fund, and then you dole the money out over that 10-year period as you wish, and you get the deduction of that $50,000 in that given year.
Correct. And what we'd look at for a lot of people is, how do we set up that donor advised fund to also work within tax law, right? So one of the things that's going to be very popular in 2023 is say, let's do 3 years worth of donations, assuming tax law is going to change in 2026. Once 2026 happens, we're likely to be able to start writing off our charitable donations again. So that
maybe.
Yeah. So if that happens, right, we want to look at doing like a 3 years worth of donations, because the hard part about the donor advised fund is you have to have, in your example, $50,000 of cash on hand. That's not always attainable for some people as well.
Or you can have $50,000 worth of securities, then you can donate and you can donate appreciated securities to the donor advised fund as well. And simply what that means is you've got maybe you've got a stock that you paid $5,000 for several years ago. It's now worth $50,000. Well, you can put that $50,000 into that donor advised fund. You didn't have to sell it to come up with the cash to put into the donor advised fund, so you never had to pay the capital gains on it.
And we wouldn't want you to sell it.
Right.
We'd want you to put it right in as stock. So,
right.
Yeah.
But I think the key here, Corey, is you want to encourage open communication with the client all year long. And before they make decisions and before they do things, before they decide I'm going to buy a car and I'm going to withdraw my money from this account or that account, they should be talking to you along with the certified financial planner to say, what is the best place for me to go and get this money that I'm going to need to spend, and how do I get it with the least amount of taxes possible?
That's exactly right. I mean, communication is key there. Telling us what it is you want to do, telling us what it is that's important to you, right? Because things like legacy planning and is, what do we have to prioritize? That puts us in the frame of mind of what's the most efficient way to get you there. That's going to look differently for every single person.
Right. And having those conversations early in a year while you're in tax preparation season, because you've already done the job of gathering all the documents and, putting everything together. Now let's have a conversation about what is 2023 going to look like. And you have any special plans for 2024? Are you going to inherit any money in the future? Do you have, do you want to accelerate gifts to kids or grandkids? And how do you do that most efficiently? All these things that people are thinking about. But at the end of the day, just about every financial decision that a person makes is going to somehow make it to the tax return.
That's a good way to put it as well, right? So how can we do that early in the year? Because we know what's coming up for the most part. We know what it is we want to do. Let us help you get there.
Yep. And here's the thing for anybody that's listening to this podcast or watching us on YouTube, if you don't have the CPA sitting with the CFP and they're not working for you, all year long. And it's not just about preparing a tax return. It's about actually shaping the future of your tax liabilities and reducing that over a lifetime. If you're not experiencing that, you're missing it.
Yeah, absolutely right. It allows me to be good at what I'm good at, allows you to be good at what you're good at, and it gives the client the best experience possible.
Well, Corey, I certainly have enjoyed having you here on the Guided Retirement Show. We'll do it again sometime soon.
Yeah, thanks for having me.
Thanks again for joining me with my conversation with Corey Hulstein, CPA. We look forward to helping you pay less tax over your lifetime. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.